All right, good morning. Thank you all for joining us. And this session is entitled, that enticing title, The Future of Money. All right, what more it can be more interesting here at the Milken Conference than the future of money. And in the tradition of the Milken Conferences, we bring together a very diverse panel, and I hope you've seen their biographies that are written down, and I'll be going over them in a moment. But this panel sort of satisfies the Milken criteria of bringing very different perspectives onto the issue of how technology is changing the way we do business and changing the way financial markets work. So that's sort of the overall theme that I want to carry in this conversation. And because so much technological change has influenced how we do business and how transactions take place, even what we use for transactions, with this notion of digital currency, digital coins. Well, a lot of it has been said, as you see in our program. We have a lot of sessions on digital currencies and how these technologies have changed things. So what's different about this panel? Well, quite frankly, this is the big boys panel. This is where multinational corporates are being disrupted in how they make payments. Central banks are concerned about what systemic risk is out there because of all these changes. We're not going to be concerned so much, except maybe in passing, about the poor woman whose family has never had a bank account, who is now able to make payments for her vegetables, right? That's another panel, and we have covered this at the Milken Conference. But instead, we are going to be concerned with multinational corporates with supply chains that cross many currency areas. We are going to be concerned with how banks service these multinational companies with huge supply chains, different revenues in different currencies, having to make payroll in different currencies in different places, and how the world of digital currency comes to play and how it will change things. And also, because it's a big boys table, big boys are really concerned about policymakers. And the policymakers we're talking about here are central banks. How are central banks going to be conducting monetary policy and regulatory policy and payment systems policy? How do we ensure the finality of payments when we have private money being used as a medium of exchange, when we have private money potentially used as a store of value? So the whole notion of money, that stuff you studied, all those things you studied in Banking 101 are coming home to roost because those notions are being changed and those notions are being disrupted. So let me shut up for now and let's get on with the conversation, because I want to introduce our panel almost one-on-one, and let's start with the disruptor. Right? One of the companies that has been so notable in introducing a new technology, a new payment system that almost threatens to get rid of SWIFT. And so, Sagar, who are head of regulatory and policy issues for Ripple. And Ripple is that company that has developed not only a medium of exchange, but also a whole payment system that, tell us about. Why is it that SWIFT should be sweating because of your presence?
Thanks, William. Thanks for the kind words, and good morning, all. It's a pleasure to be here today. Before I answer the question, I just wanted to talk about two dates. 15 September, 11 years ago, was when Lehman filed for bankruptcy, 2008. And yesterday was the 7th anniversary of Ripple. So I thought it'll be good for me to go back into time and start from where it all started. So the financial crisis led to a deep distrust in the banking sector. And some argue that really triggered the invention of Bitcoin and the Bitcoin blockchain. Our founders were actually involved with the Bitcoin blockchain movement. But the narrative back then was, it was almost like a cult-like following in the Bitcoin community, where people felt that the Bitcoin will become the global reserve currency, Bitcoin will replace all fiats, and the narrative was down with banks, down with central banks, down with governments. Our founders, while they appreciated the technology behind Bitcoin, they were not very happy with what was going on in terms of the narratives, and also there was some issues with the technology itself. So they pulled out from the movement and they launched the company 7 years ago, Ripple. We decided from the get-go that there was a massive need for disruption in the payment space, but the disruption will happen from within the trenches of financial services, not from outside. So we decided 7 years ago that we will actually work and partner with banks, financial institutions, central banks, and governments. And that's really when the journey started. Our mission is to create a new Internet of Value. And what I mean by Internet of Value is a new internet where money can move as fast, in real time, as cheaply as information moves today over an email or over a WhatsApp message. We identified two major concerns with the cross-border payments infrastructure. And mind you, in the past 40 years, no one had dared to enter the cross-border infrastructure space. A lot of startups were trying to maneuver the whole space and coming out with apps which were customer-facing, but no one targeted the infrastructure problem. So we identified two issues with the infrastructure for cross-border payments. The first issue was connectivity, and the second issue was liquidity. Now, back then, the government and regulatory focus was, they felt that blockchain was good, but crypto was bad. So which is why in our connectivity solution, it was a solution which directly competes with SWIFT, as you mentioned, but we believe it's a generation shift to what SWIFT offers. So the connectivity solution doesn't actually use a digital asset. It's a piece of software that uses DLT technology. And all it does is it has a two-way messaging system and also a settlement layer where a protocol actually debits and credits the balance sheets of the two banks. As of today, we have around 200 banks and payment providers on the network using the software live in production. And this leads to real-time payment and very, very cheap and very efficiently and with a very, very low error rate. Now, last year, we also launched a liquidity solution, which we call the on-demand liquidity solution. That actually caters to a very specific problem of liquidity within the banking sector. As you would know, today for cross-border payments, banks and payment providers have to rely on pre-funding, either with pre-funding relationship with each other or through nostros vostros. So that leads to a lot of trapped liquidity in the system. So we believe that banks and payment providers could leverage a digital asset to source liquidity real time. Again, to tell you a story, 3 years ago, we actually experimented with 12 banks across different geographies who did not have pre-funding relationship with each other. We gave them a bunch of digital asset called XRP and asked them to use it to see if it works for cross-border payments as a bridge currency. They came back to us after 6 months and they said, look, it works beautifully, but we cannot use this. And there are two issues with this. Number one, it's highly volatile, so we cannot use it. Number two, my regulator will never allow me to use this. There is no risk weighting to this, and it's too volatile. There is no way the central banks will allow me to use this. This was in 2015-16. So what we did was, and this is 3-4 years ago, before the whole concept of stable coins came into being. So we went back to the drawing board and came out with a new product, as I mentioned, ODL, on-demand liquidity. And basically what that product does is, through that product, banks do not have to hold a digital asset on their books. They could leverage that product, connect with a digital asset exchange, which, mind you, is fully licensed and supervised, and then leverage that exchange to source liquidity in real time. And because the entire transaction happens in less than 30 seconds, because of the speed of the ledger, the volatility risk is taken care of. So we removed the two big concerns that banks and payment providers had and almost productized it in a way, and then we launched the product last year in October. So that's really what our journey has been so far. And if you combine the two blocks, connectivity and liquidity, what we are looking at is an Internet of Value, as I mentioned, where exchanging money and value would become as seamless, as cheap, and as real-time as exchanging information.
So let me see if I understand this. I'm a simple macroeconomist, right? I really know nothing about a lot of this technology, yeah, and certainly not about payments. In the world of SWIFT and real-time gross settlement systems, which was a vintage 1970s creation and maybe 1980s, SWIFT gave everybody an identifier and then essentially said, okay, if you need to make payments from dollars to euro, somehow I will be the interface that allows you to take something from Target, the real-time gross settlement system of the euro area, and throw it into chips, right? And somehow if the banks are open on both sides and it's not a bank holiday, you can get paid. Yeah. Is that sort of the notion that you were facing? And now you come up with a a network that says, well, if I can get instant liquidity, that is, I can have a pool of liquidity from dollars to, say, XRP, and I can make that exchange quickly, your speed of transaction is so fast that by the time I get to the euro area, I can switch right back to euros, and the exchange risk that I bear is in seconds.
Yeah.
Is that kind of the
Absolutely.
That's the technological
Absolutely.
breakthrough. So,
Absolutely.
so essentially, one of my first jobs when I got to Citi, and before I was their chief U.S. economist, I was assigned to their transaction services. The Citi transaction services, right after the crisis, was the only part of the investment banking Citi that was making money. And they were making money in part because of that trapped liquidity, right? The banks were able to use that trapped liquidity, which could be there for hours or days or depending on the bank holiday, possibly even longer. So that huge disruption to the banking business is something that you are coming to and saying, I can lower the costs. But SWIFT and banks are not stable targets, right? They also see these technological developments.
Yep.
So banks have come up with digital coins. JP Morgan, for example, has a digital coin. SWIFT has come up with GIP, right, instant, almost their version of instant payment. So SWIFT is saying, hey, we can do that too. So how do you guys come back to them and say, can you really do that? What is it about you, what you have to offer that SWIFT and JP Morgan can't do?
Sure. So I think there are multiple aspects to this. The first thing is, in my view, cross-border payments will no longer be a zero-sum game. There won't be any monopolies. There'll be different rails, different networks. There'll be a SWIFT network, SWIFT GPI network. There could be a central bank issued digital currency rail. There could be a Ripple network, and so on. It's really about how you interoperate between those networks in the future. But that's for the future. To answer your question, you talk about SWIFT. So SWIFT is only a messaging system where two banks communicate with each other. Now, the earlier SWIFT version was where banks were communicating with each other without a tracker. SWIFT GPI, what it does is it attaches a tracker to the message. It also forces banks through an SLA to say that you need to settle the payment in XYZ or in 1 or 2 hours time. So that's what we are doing is we are removing friction not through SLAs, but through technology. So that's the biggest difference. You talk about JP Morgan and stable coins. I think this is a very, very new phenomena as recent as last year. So we still need to see how this plays out in the future. Of course, there are potential benefits, but there are also a lot of risks related to this. Of course, the BIS, IMF, everyone has written about it. And so I would love to hear your thoughts on stable coins. But I think it's very, very early days. Ripple has been in business for 7 years, so we have gone through a lot of pivots. We have gone through a lot of research, a lot of learnings, and we have reached a stage after those through that journey.
So let me continue the conversation with a real expert on this matter. Hyun Song. He not only is a scholar and famous academic from Princeton, but right now he wears the hat of the head of research and economic advisor to the Bank of International Settlements. And for those of you out there who don't know what the BIS is, it's the central bank of central banks, right? And Hyun has done some fabulous research and has written very clearly on how these transformations are changing the way essentially the world works. So Hyun, take it over and let's put this more into perspective and let's have your thoughts on how these developments are changing business models and practice.
Yeah. Well, thanks, Bill. I think it's very timely that we talk about this issue this week, given the events in the repo market. The events in the repo market this week are really about the payment system. It's the fact that banks are short of cash. Now, what this means is, and this is in spite of the fact that banks hold huge cash reserves at central banks as a result of the asset purchase program. I think what this shows is the payment system, especially the wholesale payment system, is a really elastic system, which depends very much on the actions and the behavior of the market participants. Typically in the RTGS system, you have many hundreds of times of GDP being rolled over for any given year. And you talked about trapped liquidity. I'm sure there are lots of people out there who wouldn't mind a bit of trapped liquidity right now.
Of course.
So I think we have to be very clear as to what the technology is contributing. because ultimately this is really about the economics and about what the role of the central bank is. I think the big advance that we've seen in the last few years has been in the development of peer-to-peer transfer. So the wholesale payment system, as you know, is very much based on interlinked balance sheets. So commercial banks have deposits in the central bank. It's a two-tier system, and then commercial banks pay each other by debiting the account of the payer and crediting the account of the receiver. So you need a chain of balance sheet interconnections. So what digital tokens have done, especially DLT, is to leapfrog that and have peer-to-peer transfer. Now, that sounds wonderful, but remember, these are pre-funded systems. So as long as these tokens are outstanding, so what are these tokens? These tokens are claims on a deposit somewhere. So these are depository receipts. So as long as these tokens are outstanding, there is a bunch of money that's trapped somewhere, to use your terminology. I mean, it may not be the Nostro accounts in your correspondent bank, but there will be an account where you have pre-funded these systems. So I think the first thing is to really, for us to be clear as to what the underlying economics are, as opposed to simply the technology. Now, it's true that the technology has actually leapfrogged the need to have a chain of correspondent banks. And this is one of the reasons why retail payments, especially cross-border, has been such an issue. Because it's very expensive to find this chain, especially for small sums, and typically this leads to financial exclusion. For wholesale payments, which is what we're talking about today, that is far less the case. And as you said, we do need to make improvements in the current system. So SWIFT, there is a tremendous effort going on to standardize messaging, to extend RTGS hours, to expand the membership of RTGS to non-traditional players. So payments firms are now very much part of the RTGS system in many jurisdictions. And I think when we think about the role of the central bank and the role of wholesale payments, we have to ask ourselves, what is the problem to which this is the solution? Now, if it's liquidity economy, if the issue is you're holding too much liquidity, I think speeding up some of these payments would certainly be an answer. But be careful what you wish for, because if you economize it too much and you're sailing very much close to the wind, and we have situations like this week, then I think this is not conducive to overall system liquidity and overall system stability.
It's absolutely clear that there's a tension between economizing on liquidity and what is offered through these very quick payment systems. That allows you to sort of minimize the amount of liquidity, but in a way, the functioning of markets depends upon having sufficient liquidity. And so the tension then is, how do we ensure enough liquidity in the marketplace so that transactions can take place, signals can be had through the pricing system, but at the same time, lower the economic rent, lower the amount of waste that is involved in these transactions. In your writing, you've talked about how you envision the new architecture to develop. So how will the digital world overlap and be integrated into the traditional world? Talk about that a little bit.
You're absolutely right. So I think we're at a very exciting time, both in terms of monetary economics, but also in terms of central banking, because I think the technology is there. It's available to everyone, and the official sector is certainly a potential beneficiary of the technology as well. But
excuse me, but the last thing a central bank wants is to have all of us be counterparties, right?
Absolutely.
So what kind of things can be structured in that world?
So I think if you think about how a stable coin works, a stable coin is actually potentially a very rigid system. You have to have the backing assets to issue these deposits. But what we're seeing this week, especially with the liquidity injections by the New York Fed, this is showing you the need for the central bank to have a very flexible balance sheet. And flexible balance sheet means providing overdrafts or providing collateralized loans to the commercial banks. Now, that could be in the traditional account-based system, and this is what's happening right now, or it could be in terms of these new tokens that are the claims to the deposits in the distributed ledger technology platform. But the underlying technology is really secondary to the underlying economics. So I think we have to be, so I would come back again to the idea that we focus on liquidity creation and liquidity distribution in the system. And I think there is a very tangible sense in which some of the new initiatives, and you mentioned JP Morgan coin and utility settlement coin, these new initiatives are an additional tool whereby we can distribute the additional liquidity in a way that's going to be conducive to overall system liquidity.
I hear the long arm of regulation coming up, and we'll be talking about that in a moment, but be forewarned, he's a regulator. Shamik, you're the guy who sits here with a business model. BNY happens to be an asset manager, right, but also has a transactions business. The way I characterized Citi's transactions business was a little disparaging, perhaps, but they are making a ton of money. And they do it because they can effect these transactions across different currencies and different time zones, different geographies. They have, Citi prides itself on its great international network, right, of being able to do this. It seems as though technology is changing these bank business models so that the notion of what the necessary network is changing. The notion of what kind of assets do we really care about for wealth management, for as a store of wealth in economics, as an economist would call it, right? Talk to us a little bit about how you and your business would view these developments and how your own businesses are adapting to it.
Thanks, Bill. Yeah, I'm a simple macroeconomist as well, so please bear in mind the quality of my comments given that. I mean, I think what I've taken from both Harish and Hyun is a number of things. First, from Harish, that the narrative is changing. Sagar, that the narrative is changing. Second, that effectively the insiders are heavily involved now. This isn't all about external disruption, and I think we need to draw a distinction between the future of payments technology and what that's going to look like, what the industry structure for intermediaries is going to look like, and the future of money, which I think is a much broader subject. So first of all, that the narrative has changed and that the insiders are involved. And secondly, when we're talking about the future of money in particular, I agree very much with Hyun that we need to think hard about what problem it is that we're trying to solve here. Taking the first from the point of view of a large bank and asset manager, it is clear that there's change is coming and hugely disruptive change. We don't want to I think the incentive from a large banking institution like that, like ours, is not to be either to be too reticent about change, or either to pretend that we're going to lead this. What we're going to have to do is embrace it, and I think things like unique settlement coin, which is something that we've contributed to, is an example of the kind of existing insider-led technological change that we're very, very happy to sponsor. And ultimately, I think we recognise that the industrial structure will change, that the network externalities, the transactions costs, the informational asymmetries that have allowed the current structure of intermediary-based settlement is going to change. But I think that's going to be very much a process of evolution, not revolution, and one in which the insiders like BNY Mellon will be involved with heavily. When it comes to the future of money, which I think is a much bigger and more difficult and deeper subject, I think I'm a little bit of a crypto skeptic, essentially because of the issue that Hyun raised. What is the problem that this is a solution to? And again, if you take it back to the economics, because I do think this is about economics fundamentally, not technology, the currencies we've seen emerge to date suffer, I think, from 3 or 4 problems. The first is that none of them fulfill the traditional 3 definitions of money. They're not stores of value, they're not mediums of exchange, and therefore they're not units of account either. That might change. going forward. But again, I think that that'll be an evolutionary process. Secondly, with something like Bitcoin, and Sardar outlined very clearly what the genesis was in terms of the financial crisis, there's also a sort of a quasi sort of libertarian fear of the debasement of fiat currencies at the heart of Bitcoin's existence and other digital currencies' existence. The problem the world faces at the moment is completely the opposite one. We are in a situation of potential deflation, not inflation. And the widespread adoption of a fixed money supply alternative would be absolutely disastrous at the moment. And therefore, I think it will come, it will replace gradually, but it will be market determined, and the benefits of existing fiat currencies, I think, will be understood over time. And the third reason I think I'm slightly nervous about crypto is again, what problem is it designed to solve? The existing RTGS system is incredibly efficient, incredibly cheap. The one area in which disruption might evolve is in cross-border payments. But even there, right, you're talking about a $300 billion revenue industry on transactions of about $135 trillion. So that's less than 0.3%, essentially. I'm not saying that won't change, and it will have to change, and it will change, I think, with the cooperation of the insiders, and it will change our experience. I like the sort of snail mail to email analogy. That essentially, we used to send. Well, some of us used to send airmail, and it used to be a very costly thing.
Yes, I have sufficient gray hair that I like a lot of stamps.
So do I. It used to be a costly thing. We used to have put a different stamp on, and a different postal system would deal with it in different countries, and they'd have to coordinate. Now we just click on a button and send an email. And I'm sure the future of international payments will be like that. But don't kid yourself that this is a huge economic welfare gain, because you're talking about relatively small sums of money at the end of the day.
And that's a great point. And let me key off of that. The notion of money. Money is generally associated with sovereigns, right? Sovereigns issue money. And now we have private sector institutions issuing money. Not only institutions, but institutions that are not banks. Banks that are regulated, right? So we have non-regulated entities offering what is supposed to be money. And Harish comes to us with a very different viewpoint. Neither regulator, nor technological innovator, nor well, you do have an economics degree, so you're an economist, so I can't take that away from you, right? But Harish comes to us from the world of risk assessment. He's the kind of guy you go to say, should I go to this country or not? So tell us, right, from your perspective, when you hear this kind of discussion, what are you telling your clients about the world as it's going to be evolving? What should they be running for cover for?
So there's two things which have struck me about the conversation thus far, both of which I think are correct, but I think there's a little bit of finessing and a slightly different perspective of looking at it. The first is asking, what problem are we solving? And we're looking towards financial problems, economic problems, but I feel in some ways that ignores a larger political question, which is going to determine the speed in which the payment system and the money system evolves. And the second is when we look at the economic coming before the technological. For better or for worse, there's always the political element of it as well. And from here, there are two different issues, both of which I find to be fascinating. The first one of these is who innovates and why. And I think there are more than just economic reasons for that. And the second is, when you look at the private sector as potentially the driver, as it has been thus far, when it comes to new payment systems and new forms of money, what challenges does that present? Let's just talk about the first issue first, which hopefully isn't too parenthetical to the discussion that we've had thus far. One thing which is very notable if you look at the last few years has been a concern across the world, in the European Union, but particularly if you were to look and talk to people in Moscow or in Beijing, about the dominance of the US dollar. And you saw Mark Carney talk about this at Jackson Hole, but his concerns were primarily economic. But if you were to ask someone in Moscow or ask a policymaker in Beijing, they would highlight something slightly different, which is one of their fears about a US dollar denominated payment system, particularly when you're reliant on correspondent banks, which are themselves reliant on the US dollar and therefore effectively under US jurisdiction, is the amount of power that the US government has in being able to prevent certain kinds of transactions. The paradigm case of this right now is when it comes to the Chinese being able to, or the Indians, or even a set of other states in Europe being able to buy Iranian oil, which obviously is a slightly different issue this week than it was last week. But the reality is that it is very difficult for them to do so because they don't have easy access to large payment systems which avoid the US dollar entirely. And while there are new systems in place, new SWIFT systems, JP Morgan coin, that doesn't actually solve their problem because those still fall under US jurisdiction. And this is where I think lots of the push of innovation is going to come from. That within Beijing, can we create a system which allows us to skip the need for us to transfer into US dollars or avoid banks with a large amount of US exposure? And I think the idea is that a digital payment system, private or even potentially central bank, but I think private is probably the way that people are going to go to begin with, will be a way in which they think that we can transfer money to a host of states without being as concerned about the US Treasury and about the Fed potentially imposing secondary sanctions at the limit of what the consequences might be. And I think the reason why this is important is when we want to look at fast adoption and fast development, this is going to be one of the major reasons to do it. The economics at this stage is questionable. There are serious problems in terms of liquidity. There are some technological issues, how fast these payment systems work, and it's going to take years to solve some of these out. But that political reason, the ability to move away from the United States and the power the US has had, is going to be a massive accelerator when it comes to these developments. And I think that we're going to see China at the lead of this. I think when they introduce their digital currency, the central bank digital currency, which is meant to be in November, but I think that could easily be pushed behind, this is going to be one of the factors which is going to be accelerating that development. But the second issue is somewhat different than that, which is what happens when you both have a state sector involved and you have a private sector involved. We got very used to the idea that printing money is something which sovereigns do and not something which sub-sovereign entities, companies, financial institutions, or otherwise, e.g. Facebook, end up doing. And I think this is a curious question because we don't really understand how that is going to evolve. We can look back at history, eras of free money, even if you look, for instance, at Friedrich Hayek, who talked about in the 1970s the benefits of private money. Well, generally speaking, we've been very skeptical about it, and the outcome of that hasn't been very positive. But there are serious difficulties that is creating for governments, all kinds of economic pressures and regulatory pressures which didn't exist before. And I think it's going to be very difficult for governments to be able to deal with it. Now, I think there's two ways that evolves. One way is the hope that when it comes to money itself, on the retail side as well as the wholesale side, states are going to become more and more involved. And we can hope for regulatory approval for a range of other private solutions, but I think that's going to be very, very slow and isn't something I'm necessarily expecting in the next 2 or 3 years, particularly in more Western states. So I think it's a very complicated political issue, irrespective of what states you're doing or what you're looking at. But I do think the implications of that could potentially be very large for the entire world economy and the way in which we believe the payment system currently operates.
Fantastic. Geopolitics, right? You never thought that cryptocurrencies would lead to geopolitics. Hyun, you've written so much on this particular issue. I can't resist but to draw on your expertise yet again. Dollarization, right, is a problem that economies face all the time. And what is this dollarization? And I'll let you define it. But for me, the world that Ripple and particularly Facebook offers really introduces this notion of whose currency is going to be the dominant currency within some geographic area. And the reason why I talk about Ripple and Facebook is because Libra is essentially a basket of currencies, right? It's like a private sector SDR, right? Especially drawing right to the International Monetary Fund issues. And the International Monetary Fund issued the SDR as a means of payment among governments, among central banks, to resolve balance of payments, deficits and surpluses. So in this world where we have a private sector SDR being issued, which has difficulties of credit risk and other things that I'm sure you talk about, how will the world evolve in the use of one currency or another? In particular, what governments would really allow these digital currencies to enter, to be used in their economies? And what governments would really be out and out restricting their use and making it illegal? It's like you get shot if you use it. Please.
Well, thanks, Bill. I think for this question, it's very important for us to recognize the importance of the monetary system as part of the economic system. The monetary system doesn't exist in isolation. I mean, there must be very many buy-side people in this room. How many of you are dollar-based investors? How many of you are non-dollar-based investors? If you're a Japanese yen-based investor, how much of your portfolio is in US dollar assets? And the answer, I think, is a very substantial chunk. And how you deal with the currency risk? Well, you hedge it. And how do you hedge it? You sell dollars forward to a bank. And how does the bank hedge? The bank has to then borrow dollars to do that. So I think the key here is it's not so much the holding of dollar cash, it's the borrowing of dollars. And in that respect, these new instruments may only have a limited impact on the degree to which dollar remains preeminent. And why is it that a yen-based investor, Swiss franc-based investor, or a euro-based investor has so much dollar-denominated assets? Well, it's because the borrowers issue in dollars. And what do they issue in dollars? And many of the issuers are non-US borrowers. So all around the world, borrowers issue US dollar-denominated debt. Well, that's because that is the liquid market. And why is it a liquid market? It's because everyone else issues in that market as well. And why do we have that situation? Well, it goes all the way back to very basic things like how do you invoice your trade? So if you invoice in US dollars, then of course your working capital has to be in US dollars, and then the bank has to lend you in US dollars, or your investment cash flow, for cash flow matching purposes, you would like to borrow in US dollars. And that's why there's so much US dollar debt out there, and so we go around full circle. So I think once we recognize the fact that the monetary system has to be a part of the whole, then I think this question is not simply about the technology, and I come back to that. It's about the underlying economics and the underlying economic relationships. And central banks have a very important role to play there as well.
And here, let me add, then, if it's about economics of trade, economics of invoicing, economics of a marketplace, Facebook's got 2 billion people in their network. Facebook Marketplace suddenly denominates their products in Libra and says to everybody, you stay within the family, you just use Libra. And to hell with the dollar, right? We don't need to use the dollar. Within the family of 2 billion people, we can just denominate in Libra and we can go on our merry ways. And you have all the benefits of instant payment, instant credit, instant everything, and at no transactions fee cost. What's wrong with that?
So I think you put your finger on it, which is, will there come a day when merchants invoice in Libra? And I think Libra is a very, very important development for us because of its size. It also raises some really interesting and fundamental questions about the nature of money and how a stable coin of that sort would fit into the monetary system. You may have seen the press reports earlier in the week when we invited Libra, JP Morgan coin, and utility settlement coin to the BIS. And we had an all-day meeting. We had 150 regulators in the room. We had a very in-depth discussion of the
Tell us about it. Tell us about it.
And I think it was a very good opportunity for us to come to a common understanding of some of the mechanism. I think if we go back to the earlier point about the difference between a wholesale payment system and the retail payment system, much of the motivation for why we need new solutions comes from the retail payment system. In fact, if you have a worker who is working in one jurisdiction, wants to send money to his or her family back in back home, that has to go through the correspondent banking network. Even if you use a payment app, ultimately it has to go through, at some point, the existing correspondent banking network. And there is where the cost, where the cost really becomes an impediment to sending money home. And this is what really excludes some of the least advantaged people from financial services. Now, the wholesale system is another matter altogether. Wholesale system is many, many more times, hundreds and thousands more times. And I think this is the one area where those central banks who have experimented with CBDCs, Bank of Canada, Monetary Authority of Singapore, central banks have experimented with CBDCs, central bank digital currencies. And their conclusion is, yes, the technology works, and it has a potential use in the wholesale payment system. But it's not so much better that it's an obvious advantage to use them relative to the current system. Now, as you say, the key issue is how do we make the cross-border payment system more efficient? And here, yes, of course, there is room for improvement. CLS Bank, which is, I think, a very, very important piece of infrastructure, was an institution that came to meet some of the demands of the wholesale payment system. But I think we need to make the greatest strides in the retail payment system and for remittances and for retail cross-border payments. I think this is where still the correspondent banking network is not as efficient as we would like it to be. It's not as cost-effective as we would like it to be. But I think that to think that we can just use one technology and with a snap of a finger, all these problems will be overcome, I think that is unrealistic.
I'm glad you said that. Sagar, you've been sitting here very politely, very patiently listening to all these traditional answers from traditional institutions. Please, I know you want to say something. What's your reply to the notion that, things ain't so bad, and you're giving us a solution that we really don't have a problem for? And so, and you're dealing with regulators all the time, and I think the standard notion of every regulator is, if you're going to come into this game, that bar is going to be set incredibly high, because I don't know what the hell you're doing. So explain, what is your response to these traditional answers that you've heard so far?
Actually, I agree to everything that is being said. I agree to the fact that some of the things that are being played out, there's no real need for it. There's almost, I call it the hammer and the nail problem, where there is a hammer, you're searching for a nail. That being said, it's very important to differentiate the different digital assets, cryptocurrencies, stablecoins. Very important to differentiate those, because each of those buckets have different use cases. So for example, in the crypto space, there are almost around 3,000 cryptocurrencies or digital assets. Now, you could argue that almost 90% of them will become obsolete in a few years from now, but the 10% which will remain, what is the problem they're trying to solve? Bitcoin, for example, has been in existence for more than 10 years now, but what is the problem it is trying to solve? I actually agree with Shamik when he said that it does not solve the problem of the three basic principles of money, but perhaps it could be a store of value going, who knows, I'm not an expert. But that being said, so which is why what Ripple is trying to do is focusing on a very, very specific problem. We have been very clear that we are not consumer facing. We are not using XRP, the digital asset, to replace US dollar or RMB or whatever. We are using it as a piece of technology to connect to fiats. That's all we are doing. We are not saying it will become you can buy a cup of Starbucks coffee with XRP. Maybe in the future, who knows? But for now, Ripple, the company, is focused on using an open source, decentralized crypto asset called XRP to connect to fiats. Now, it's also, people often bucket all digital currencies, Ripple, Facebook in the same bucket, but again, there is a big difference. Facebook is consumer facing. Facebook, through the Libra, will be distributing their own private tokens to retail consumers. We are not doing that. XRP is not backed by fiat or a bucket of commodities. XRP is backed by mathematics, like some of the other crypto assets like Bitcoin, which are fully open source and decentralized. That's number one. So which is why there is no counterparty or credit risk. we do not become safekeepers of the assets or fiat that back the crypto. Number two, Facebook is trying to operate in a closed loop system, while our vision and really the future is to connect different closed loop systems and make it an open loop system. So these are some of the differences which we have to keep in mind. Of course, the regulatory barrier is and will be set high.
In fact, I hear that all the time. Since you're the recipient of that statement, what is it that they're telling you? What is the bar? Where are they setting the bar? And I'm going to ask Hyun to even elaborate more. I know that the conversations at the BIS are confidential. When I was at the Fed, even I couldn't get a sense of what the summaries were of your meetings. But come on, it's just the Milken audience here. It's just between friends. Tell us a little bit. But Sagar, before I turn to Hyun, what is it that the regulators are telling you that you have to do? And how are you meeting those?
I think, again, what really is important is the use case. I think regulators around the globe are going for what they call the same business, same returns, same risk principle, or we call it the principle-based approach, technology-neutral approach. I think it all depends on the use case. So very recently, I was reading through the Switzerland FINMA that came out with the guidance on stable coins, one of the first global regulators to come out with such a guidance. They have very clearly defined that there are, if a stable coin, let's say, is backed by a single fiat, it will be a deposit saving instrument. If it's backed by a basket of commodities, then it may be treated as a collective investment scheme. So I think it really depends on the use case.
Then let me turn the other way around. Which regulators have been the most friendly toward your introduction, and which have been the most resistant? Let's get some gossip here. Come on.
Yeah, I think in the globally, I would say the Japan FSA took a lead. They were the first regulators to come out with a framework to regulate digital assets, cryptocurrencies. That was followed suit by the likes of Philippines, more recently Thailand. There is a free trade zone in UAE, Abu Dhabi Global Markets. They came out with a framework to regulate crypto assets. We have seen similar frameworks in Mexico. The UKFCA recently came out with a classification taxonomy of digital assets, classifying different digital assets based on their utilities and use cases. So we're already seeing a trend where regulators are coming out with frameworks and guidance on this. Financial Action Task Force actually recently came out with a very comprehensive guidance on crypto assets and how could regulators potentially regulate crypto asset exchanges and custodians. I think that's a big leap forward. I'm hoping that in the future, the G20, in collaboration with FSB, IOSCO, will come out with similar frameworks. And in my ideal world, what I am thinking is an IOSCO-like CPM, PFMI kind of a framework for digital asset exchanges and custodians. And that really will trigger more institutional participation in this space.
Okay, Hyun, all eyes are on you. What is it that you're telling these guys?
Yeah, so Bill, I think the first thing to say is that we're not complacent and we're not backward looking. Central banks are not against technology. Central banks are not against innovation. And as a case in point, the BIS has set up the BIS Innovation Hub, one of whose centers is going to be based here in Singapore. You may have seen the press reports about that too. In fact, central banks find themselves right at the cutting edge of innovation. And these innovations really impinge on every aspect of our work, from the monetary system, from regulation to monetary policy. And you can rest assured that we are not complacent. We are not regulating for regulation's sake. We are here simply to see how the technology can contribute to a more efficient financial system, to a more stable, and something that will actually be more conducive to having a system where we don't see headlines about banks running into the corner, there being shortage of liquidity, and short-term money markets being squeezed as we've seen this week. So there is definitely room for innovation. There is definitely room for institutional development. So, and in that context, we have been very open, and we have studied these technologies now quite in depth. And you can rest assured that the official community as a whole, not just central banks, but the supervisors and the Ministry of Finance and in the retail space, both the competition authorities and data privacy authorities, this is very much on our radar screen. And there are many initiatives going, including, including many varieties of central bank digital currencies. There are now being discussed. And innovations like JP Morgan coin, utility settlement coin, the fact that we can now transfer these tokens peer-to-peer, that is an innovation. But ultimately, in terms of the architecture, it is a very standard two-tier system based on central bank money, but where the monetary system is a commercial bank private money. I mean, you said that private money didn't, that we don't use private money these days. Well, actually, it is all private money in that these are commercial bank liabilities. It's just that these are like trees with roots that are deep into the RTGS system. The RTGS system and access to the central bank balance sheet, those are the deep roots that enable the whole tree to stand up.
And that's a fantastic answer. And the reason why Hyun is where he is because he didn't tell us what they were doing. Right? So let me ask you one more time, a different way. What keeps you awake at night? What is it that you are worried about most in these developments that you've just talked about, especially given that you say that your expected architecture is going to be a two-tier one, where you've got the private money being issued to the retailers, and the retail interface and counterparties will be handled by these issuers, and then the central banks will be the counterparty to these coin issuers. So in that sense, there is a level of separation, which is reflecting almost exactly the kind of structure we have now. But in that world, what is it that you worry about?
Well, I think it's not necessarily something that that we worry about. I think this is our day job. We always think about how better to improve the system. But I think one thing that we should very much bear in mind is the strength of the governance of the key infrastructures out there, because after all, the payment system and the financial system more generally is really a critical public infrastructure. And if there is a divergence of interest between the people who run that infrastructure and the broader public interest, then I think that's something that we should consider very carefully. Now, throughout history, private monies have come and gone, and I use monies in plural. Private monies have come and gone. Some have lasted longer than others, but invariably they've given way to official sector money, to central bank money. Historically, we've had very important institutions like the Bank of Amsterdam. Bank of Amsterdam, for those of you who read Adam Smith's Wealth of Nations, there's a very famous chapter there about the importance of the Bank of Amsterdam in keeping the sound money system within 17th century Europe at that time. Now, that was backed by the city, but it was ultimately a private institution. And we've done some historical work where we document when it started. It was in its own stable coin, because what would happen is merchants would bring gold coins, and then the bank would write entries into the books. And these entries, or deposits, were used to settle bills of exchange and other financial instruments. So that was a very, very classic stable coin. It's just that you had to write it in longhand rather than digitally. But it's a very inflexible system. And what happened over the years, in fact, just after Adam Smith wrote about it in the Wealth of Nations and extolled the virtue of sound money, was that it was pulled in the direction of being more flexible. It's in the direction of granting overdrafts, where you actually gave loans and you wrote in entries to the deposit to give greater liquidity to the system. Now, the problem was, and it lent to the Dutch East India Company, the problem was this was a private institution. And ultimately, what happened was that it became overextended, and it suffered a run in 1795. And you know this very well as a former central banker. But I think those institutions that endured ultimately became central banks. And the Riksbank in Sweden is a very good example. I mean, they have a very similar origin. So I think, governance is an important issue. This is a critical public infrastructure, and we have a duty as the official sector to make sure that the public interest is looked after.
Great. For the next few minutes that we have left, I'm going to ask everyone what your great fears are, and what is it that keeps you guys awake?
Fear. My worst fear would be a particular regulator or central bank misunderstanding our technology and taking a step that impacts our business. I think it's very important that the private sector collaborates with the regulators, central banks, and educate them about what the private sector is doing, educate them about the new technologies so that they make a very informed decision. So my worst fear would be that a regulator in one country makes a misinformed decision based on a lack of awareness or lack of knowledge.
So I think the future is one where we'll get more and more central bank digital currency, in part for the reasons already talked about, that there'll be some private digital currencies, and central banks will realize that, well, governments can realize they can co-opt lots of the values. So it's going to be a very mixed ecosystem of the private sector in some areas and central banks in other areas. I think one of the real risks is, irrespective of how far we go in terms of regulation, the regulatory environment globally is fragmented, where we will have different regulators doing different things, and lots of the risks will not be fully appreciated by some national regulators when they go ahead and both create central bank digital currencies, but also when they try and evaluate the prospects of private digital currencies. I think that could create both systemic risks, but certainly localized risks over the next 5-10 years. I think, as Dornbush would say, that sometimes it takes much longer than we ever expected for something to change, but when it changes, it can happen much faster than we ever thought it would. And I think that becomes somewhat present as a risk when it comes to such a large change, even for an extended period of time, with changes to the monetary and payment system.
Shamik?
Yeah, I mean, carrying on from Harish's quote of Dornbush, I guess for me it would be another major financial crisis that served, maybe related to the unraveling of the search for yield or something like that undermined the integrity of international banking systems and, by extension, the dollar standard. And that happening before a lot of these innovations, which I think ultimately will contribute to the stability of the international financial system. It happening before those innovations are in place, and that we have all kinds of genuine, real economic dislocation because of that. That's the thing that would concern me.
I'm afraid I also have the moderator's fear that I'm running out of time. I've got 2 minutes left. Are there any questions from the audience that we can take in the last 2 minutes here?
Thank you for the discussion and the panel. Just had a question that, obviously the regulators are playing a very critical role in this. How much and how often do the regulators talk to each other? Because it's very obvious that some regulators have taken a pretty pragmatic approach and they're engaging with companies like Ripple to understand the situation, and some others just like to follow suit. But how often do they discuss this, and how, are there some taking the lead in getting others up to speed on this?
Well, regulators meet all the time. I think here there are different overlapping circles. I mean, there are the central banks who are the overseers of the payment system, whose concern is more broadly with the stability of the financial system itself. And there are the banking supervisors. Then there is the broader umbrella of the Financial Stability Board. And there are overlapping circles where, depending on the topic, depending on the particular issue at hand, we would meet very regularly. And they would often come to Basel, where we're based. And I think the fact that we are meeting so often, we're discussing these things in depth, means that we gain a much better understanding, but not only understanding individually, but come to a common understanding. This is, after all, a coordination issue. We have to have consistency in the way that we address industry participants, industry innovators. I think that common approach is going to be one of those, I think, one of the important themes going forward.
All right, I'm being given the hook here. I'm sorry we can't take any more questions, but our guests are